Hello, my name is Jim Obold, and I'm the president of Servant Solutions. And welcome to our webinar titled Market Volatility and Recessions 101. I'm joined by my colleagues, Dr. Jerry Fox, our Director of Financial Planning, and Ellen Daniels, our Director of Engagement. We promised you a webinar of about 20 minutes, so we will watch a 12-minute video together from our friends at Principal Financial, our partners there, and then end with a Q&A session with me, Jerry, and Ellen. So let's get started.
If you watch the stock market or the national news, you'll probably hear about the market trending up or down over the course of a day, week, month, or year. This is called market volatility, and it's normal. In the next few minutes, you'll learn about what causes market volatility and how it may impact your retirement savings. We'll also talk about recessions, what to look for, and how to prepare for the next one, whenever that may be. Let's get started. One institution that can affect the market is the Federal Reserve. The Federal Reserve, or the Fed, is in charge of money and banking in the United States. One of the Fed's main jobs is maintaining the stability of the U.S. financial system. They do that by raising or lowering interest rates, and one in particular, called the federal funds rate. That's the rate that banks charge other banks to borrow money for short amounts of time, usually overnight. The federal funds rate doesn't directly affect most people, but you can still feel its pull because it influences another rate called the prime rate. The prime rate is the rate that banks charge their best customers. So when the Fed changes the federal funds rate, the prime rate typically moves in the same direction. The prime rate is a reference for other interest rates, which means it can trickle into areas of your own personal finances by impacting how much interest you pay on new loans or credit card rates. It can also alter how much interest you receive from savings accounts and at what value bonds are bought and sold at. If you hear the Fed is changing rates, don't feel like you need to react immediately. Depending on your situation, rate changes may take time to make an impact on your wallet, and not all rates are impacted equally. For example, adjustments to the prime rate usually only impact the interest charged on new loans or adjustable rate loans. If you have a fixed interest rate mortgage, your rate isn't going to change since the prime rate went up. In addition, other items that pay a fixed interest rate will not be impacted either. Now that we've discussed the Fed's role on interest rates, let's talk about GDP, or Gross Domestic Product, and learn about the role it plays in volatility and recessions. What's considered GDP? Every day all across the country, people go to work, everyone from farmers and factory workers to chefs and doctors. Together, they produce all the goods and services that make up the United States economy. The GDP is calculated by adding together consumption, investments, government spending, and exports minus imports, and is generally reported in dollars or as a percentage change. When the economy is growing, the GDP number gets larger as workers make more products and perform more services. But on occasion, the GDP number gets smaller, and that can lead to a recession. In order for a recession to happen, there must be 2 or more consecutive quarters of GDP decline. The National Bureau of Economic Research looks at data and declares when recessions start and end. In addition to 2 or more consecutive quarters of GDP decline, other data they look at includes total employment numbers, inflation-adjusted household income, wholesale and retail sales figures, and industrial production. When they see a sizable decline in all 4 sections for 2 or more consecutive quarters, the U.S. is likely in a recession. Now, let's turn our attention to volatility and learn why it's an important part of the market. It may surprise you to learn that healthy markets have some volatility to them. The rises and falls are what allow stock markets to deliver returns over time. So even a little volatility may bring opportunity. At the same time, markets may sometimes overreact to information. Although it may feel like it, markets are not more volatile now than they were in the past. In today's world, risks just tend to appear more quickly. That's due in part to technology. Recent developments in technology mean information is distributed and consumed almost instantly, especially with information that impacts the market, such as when the Fed announces an interest rate change or a company makes an announcement on social media. Another thing that may make it feel like markets are more volatile now, even though they're not, is that we're more interconnected than ever to the global supply chain. So if something happens half a world away, it can affect our markets in a matter of minutes. One important note to remember: just because the market is volatile and goes down for a few days or weeks doesn't automatically mean the economy is in a recession. In fact, let's learn a little more about the history of recessions to provide some perspective. The United States has gone through 12 business cycles since World War II, and the average recession lasts about 11 months, although the 2008 recession lasted a little longer than normal, 18 months. The good news is that the 2020 recession only lasted 2 months, and the U.S. has seen 11 years of economic growth that started when the last recession ended. You may be pleased to know that recessions generally don't last as long as periods of growth. Between 1947 and 2022, the U.S. economy slipped into a bear market 14 times. That's when major market indexes dropped 20% or more. And even after all of these bear market slips, history shows the stock market recovered and provided long-term gains. Now that you know the history of recessions, let's talk about a key indicator of a recession: the yield curve. A yield curve is a plot of interest rates or yields for bonds of equal credit quality across different maturity years. A normal yield curve is upward sloping because longer maturity bonds should have a higher yield compared to shorter-term bonds due to the risks associated with time. In short, the longer your bonds are invested, the greater the yield could be. Here's another way to think about it. Think of interest rates as the price of money. When rates go up, businesses pay more to borrow the money they need to expand. When rates are lower, it's cheaper for companies to get the money they need. That interaction makes interest rates an important factor for investments because of how investors perceive the impact on economic growth. For example, in 2018, the Federal Reserve announced that it would begin raising interest rates to help prevent the United States economy from overheating, growing too quickly, and causing high levels of inflation. Markets reacted with a lot of volatility because they were worried that higher rates would limit economic growth. In 2019, the Fed reversed its course, lowering interest rates a few times. Markets took this as good news because it meant borrowing costs were lower, potentially allowing U.S. growth to continue. So, what does this have to do with a recession? That's where the inverted yield curve comes in. With an inverted yield curve, short-term yields are higher than long-term yields, predicting that the long-term market outlook may be poor. When the yield curve inverts, we usually see a recession within 6 months to 2 years. Sometimes there is lag time between the inversion and the onset of a recession, which can take 1 or 2 years. But in the instance where the yield curve inverted in 2019, it actually returned to normal again 4 months later. So, if recessions and market volatility are inevitable parts of our economy, what can you do to prepare? While it may not happen tomorrow, having a plan in place for a recession or market downturn may help give you confidence to help weather the storm. One important thing to remember: volatility is generally short-term, and your retirement goals are long-term. It may not be in your best interest to react to short-term volatility when your goal is to build long-term savings. If you're looking for a way to help stay on track with your investment goals, one thing to consider is setting clear retirement goals and determining a timeline to reach them. From there, you can base investment choices and changes on a set of stable, long-term investment goals and your ultimate retirement date, not on daily news about short-term market swings. Another way to help protect your savings is to consider your mix of investments and make sure that they align to your tolerance for risk. Risk tolerance is how comfortable you are with risk, and it can change over time. Generally, if you are further away from retirement, your investment mixes may be more aggressive since you can more easily weather the short-term ups and downs of the market. As you get closer to retirement, however, you may want to consider being more conservative with your investments since you don't have as long to recover from any market downturn. If you're not sure about your comfort level with risk, you can find out by taking a quick investor profile quiz at principal.com/investor profile quiz. You can't control market volatility, but you can choose to focus on things you can control, like your investment mix. Diversifying your portfolio may help smooth out the ups and downs of the market and align with your personal tolerance for risk. Being diversified in your accounts may also help protect you from sequence risk. Sequence risk considers the order in which your investment returns happen. That's because the timing of your withdrawals from your retirement account can impact your overall rate of return. For example, let's say you retire during an economic downturn and there are more negative returns than positive ones at the beginning of your retirement. When investments are down and you sell too many shares, it could reduce the amount of income you have available to withdraw over your lifetime. Another step you may want to consider taking is rebalancing your investment mix occasionally to keep everything aligned to your risk comfort level. That's because investments perform differently over time, and your original mix of investments can get out of whack if one or two investments overperform or underperform compared to the rest. Rebalancing helps make sure your investments stay at the risk tolerance you've set to help achieve your goals. Not sure how often to rebalance? It's different for everyone, but generally it's a good idea to consider rebalancing at least once a year. You can choose to set up a rebalancing plan for your retirement account so you don't just set it and forget it. Many plans enable you to rebalance manually or automatically, whichever is easiest for you. If you'd like to check on your account and see if it may be time to rebalance, just log into your account at Principal.com. Another way you can stay in control of your retirement savings is to plan ahead for a possible downswing. Recessions are a natural part of the economy, so it may be a good idea to have a financial buffer. That way, when the market fluctuates, you'll be less likely to tap into retirement savings or react irrationally. Here are a few tips you may want to consider. Have an emergency fund that can cover a minimum of 3 to 6 months of expenses. Pay down debt once your emergency fund is established. Consider part-time work if money gets tight, or if you just want peace of mind in having an additional income stream. This way, you may be less tempted to dip into your retirement savings and instead leaving it to potentially grow. One note though, extra income could affect taxes on your Social Security if you've already claimed your Social Security benefits, so make sure to consult with a tax professional if you have any questions. There are a lot of different things to consider when saving for retirement. If you need assistance along the way, your financial professional can lend perspective, let you know what's happening in the market, and share with you how it may affect your retirement. A financial professional can also work with you to put together your retirement plan, which can help guide you toward a long-term investing strategy. Need a financial professional? Visit Principal.com today. Congrats, you're in the right mindset. You've taken the first step to understanding how market volatility can impact your savings, and you've heard about a few things you can do to help protect your savings from recessions. Good work. Now you're ready to work toward your long-term retirement goals, no matter what the markets do, today or tomorrow.
Well, that was a lot of information in a 12-minute span, so thank you for listening to that and watching it with us. Please know that when they say see your professional, that's us at Servant Solutions. You don't have to contact Principal. They work for us, and we are your main contact. We just know that video will be in email form that will follow up with you if you wish to see that again. So if you were taking copious notes and needed to see it again, just know that that's going to be available for you. So let's dive right into our Q&A session. Ellen, can you help facilitate that for us?
Yes, be happy to, Jim. Thank you. For those of you that may not be aware, if you'll look at the bottom of your screen, there is a Q&A chat that is set up. Not everyone will be able to see that, the questions, but you can enter your question there. But we have one to get started here. Jerry, if you don't mind, I'll have you take this one. Inflation has been so high and I'm spending everywhere. Food and energy costs continue to strain my family budget. When inflation goes down, will prices also go down?
That is the hope. Are you hearing me okay, just to make sure?
Mm-hmm.
Yes, that's exactly what the Federal Reserve, under the direction of Jerome Powell, you may see him on the news every couple of weeks, he'll come out and make a statement about what the Fed is looking at. They're concerned about the fact that a lot of our prices have gone up. Some of that is because our economy has been so strong and a lot of people buying. When there's more demand for things, prices tend to go up. The other side of that, obviously, is supply. And when there is uncertainty in markets about supplies of energy, such as oil and some of the things that have been a little difficult because of global trends, that's going to have some impact. But the short answer to the question about as inflation gets under control, and the Fed has been fighting it aggressively with interest rates and money supply, we should see prices moderate. I know it's difficult in the short term, especially if your income stream seems to be fixed, and a lot of our retirees in between Social Security or what they're drawing from their accounts here at Servant Solutions, They may say, I can't increase this to match what my costs are. It's a time in the short term to be a bit more conservative, probably not eat out as much, to plan your travel so that you're not using as much gas, some of those things. But you also heard in the video, this is also a time to make sure you've got an emergency fund so that you're not always having to make big adjustments. And when a given month is a little bit more, you can draw upon that. But I think, yes, I'm looking for prices to moderate and hopefully come down as we get toward the end of the year.
Great. Excellent. Thank you. I feel a bit like I'm back in class with Dr. Jerry Fox. We're so glad to have him on board with us now. He is our Director of Financial Planning, and we're thrilled to have him. Jim, I'll have you answer this question. If I'm not comfortable with risk, are there certain funds that you would suggest I invest in?
Well, with any fund that we have, whether it's a bond or stock fund, Value International, there's inherent risk to that, and volatility comes with that. Matter of fact, they say that you just really can't get away from volatility. Stocks are volatile at both high and low valuations, so really volatility is everywhere. But it's good that we do have an option that's called the principal guaranteed option. That's an out-of-market option that we call what's a parking lot. It's someplace that if you really get anxious and you want to just cool the heels of the market and not go through the roller coaster, you can do that. However, the reason why we call it a parking lot is you don't stay there forever. We feel like you should be in a strategy that you're comfortable with, that moves along with your age and time horizon for retirement. So risk and volatility are inherent, and we just have to be comfortable with it if we're going to be in the market. And the market is the only way that has been proven over time to fight the very question that you asked Dr. Fox, and that is inflation, which I just say and feel is the silent killer of our retirement portfolios. There is a risk of being too conservative too fast, especially when you're retired. So it's just a matter of perspective. But the great thing is, just like the video says, that retirement planning is a long arc proposition. You dollar cost average into the market as you're in your career, and then you dollar cost average out of it. So you're making micro gains and micro losses, not lump sum gains or lump sum losses. So that's a matter of perspective, and it helps a little bit for us to deal with volatility.
Excellent. Thank you so much. Next question is a good one. I want to retire in 5 to 7 years. How can I maximize my investments during this time? So first thing I think of is what Jim just mentioned, our PGO fund, principal guaranteed option. But Jerry, how about if you add to that? What are some thoughts you would have for this one?
Well, the key element in that question is the time horizon. Time is the great multiplier. If you want to think about investment growth, there are 3 pieces to it. One is how much are you investing? We call that the principal amount that goes in. Second is how much are you earning on that? And then the third is how much time is that earning compounding? Well, I just counseled with a couple on Zoom this afternoon. They're 35 years old. So they've got 30 years or plus to watch the market go up and down. They can weather a few more of those fluctuations. They can take a little more risk. So what they're putting in, again, that principal amount, they can be a bit more aggressive to get a little bit higher return to do that. And they've got 30 years for that to happen. But the question said, I've got 5 to maybe 10 years. When that shrinks down, you probably need to be a bit more conservative. And that's where our age-based life funds will help do that automatically for you. You choose a fund that is based on your birth year, and our friends at Ronald Blue Trust help rebalance that as you get older. They get more conservative to try and make sure that you're not exposed as much to the downside of market downturns. But in exchange for that, you're giving up some of the upside growth that might be a part of that as well, because your timeline is such that if there was a big downturn within that 5-year period before I retired, and my balance went down, that would limit my options at that point. So you want to get more conservative as you get closer to your target retirement date. And that's where our age-based life funds do that automatically. The other piece of that is what Jim was talking about. I don't want to give up all of my opportunity to beat inflation as markets grow, because inflation means that all things are increasing in value and cost. But if I'm a net investor, my investments grow in times of inflation, or can. And I don't want to completely give up on that. That's why the age-based life funds keep you in the market and give you some of that upside, but do so more conservatively as you get older.
Yeah, I agree. If I could just add on to that, that was a great explanation. I think there's a lot of focus on our retirement date, but really what we focus on at Service Solutions is to and through retirement.
Exactly.
Our strategy is your retirement date is just one small part of the strategy that comes into play, thinking about your retirement. Actually, our expiration dates off this earth are more important than even that date. Right. But so that we try to look at longevity and family in our financial planning, and really what's your unique, the items that you bring to your situation, your financial situation, whether there's inheritances, Social Security or not Social Security, all those things come into play. And that's why our financial planning really is a great tool that's free of charge for all our members that Dr. Fox heads for us.
Right. Jim, how about if we take one more question? I know we're good to keep to our time frame that we've promised. This one goes along with what we've been talking about. I'm 6 years away from retirement and have invested well. I'm wondering if we should also discuss or contemplate annuities to have some money coming in maybe 10 years after we retire.
Yeah, annuities are part of a strategy as well. If you are in Social Security, it isn't, for lack of better words, an annuity. It's a lifetime income that you can begin, and it lasts for your lifetime. It even has cost of living adjustments. Now, and there's also some worry that benefits may be cut in 2033, I guess, is when they find out that it kind of, there's some some concerns about it being funded fully. So there's a lot of variability there. And so I would say that annuities are an option, but it would be part of our financial planning would be to see if that's a good option for your time and for your diversification of your entire portfolio and income streams. What I think what annuities can serve well is that for your basic needs in retirement, but you do not want to put all your money in annuities. You want some money that's flexible, that can meet other discretionary needs, such as maybe another car or an investment or emergency need, a roof or something like that. So I think a combination of both, and we've seen some folks that have recently retired take that type of hybrid approach to have a lifetime income stream and also some flexibility with a balance in an account.
Great. Excellent. Do we have time for one more?
Yes.
Okay. Jerry, how about this one? How have bank failures earlier this year impacted retirement accounts?
Well, you might want to look at why the banks failed. And it's a case where they were making bets on the future with other people's money and extending themselves to the point that they increased their risk beyond what they had the capacity to support. And it's this old idea that, hey, I'm going to flip houses. I'm going to buy them because house prices are going to do nothing but go up. So I'm going to borrow as much as I can and keep buying as many to do that. Well, ultimately, you run out of, it's what we used to call the greater fool theory. I paid too much for this house, but I'm going to find somebody more foolish than me to pay a little bit more. Well, you run out of fools eventually, and then it all begins to collapse on itself. And that's what happened to those banks. What we're saying at Servant Solutions, don't do the same thing with your retirement fund. Don't take unnecessary risks. Take well-measured plans for the long term, not for short-term gains. The short term of, should I worry about the bank that my money is in? And maybe you do want to take a look at its how solid it is. Look across what your state bank regulators, and you can find that if you look in your state, if you just Google that, what are the safest banks in my state? And they'll tell you that. But for most of us, probably not a big deal unless I've got major investments in CDs or in savings accounts at a bank. And even then, if it's FDIC insured, you will eventually get your money back. It's not a quick process if your bank fails, but that has removed some of that risk already.
Excellent.
Well, thank you, Ellen and Jerry, for being part of our panel. And again, if you have registered for this webinar, you will receive an email with contact information in case you wish to follow up with us about your specific questions. We appreciate you taking time to be with us today. Have a blessed afternoon. Thank you for attending our webinar.